earlier, my colleague Ramah Nyang spoke to NCBA's Managing Director, John Gachora. He started their conversation by exploring the delay in getting new risk pricing models for loans approved.
If I look at ourselves, it's not really a point of contention. Is that over time we have developed risk-based models that have been fairly complex, they're fairly specific to the type of business that we do, the target customers that we have, and in fact divided into our corporate, large corporates, SMEs, smaller corporates, retail, and obviously our digital banking. And so I guess the conversations we've been having with the central bank is how do you take all these formulas, simplify them well enough so that you can explain to any customer who walks through the bank that this is how your pricing is going to be determined based on this risk-based pricing formula that we have.
Do you expect to wrap that up by the end of the year, or is that something that you might essentially have closure on by, say, the middle of 2022?
Well, I think it's more likely sometime next year. And I say that really because, one of the big inputs that we have had to our credit formula has been CRB scores. And given the fact that there is a CRB moratorium until September of next year, it means that we have to go back and we look at some of our formulas. And so that's why I do not think it will be done by the end of the year, but it should be close soon thereafter.
Okay, so getting back to your results, the size of the loan book did contract a little bit by about 4.2%, but your holdings of government securities actually did go up by a fair bit, up by around 25% compared to the same period last year. What sort of weaknesses are you seeing in demand for private sector credits as we essentially start to recover from the pandemic?
As you have mentioned, obviously there is a weakening on the lending side, but what you see is customer deposits closed up 11% year over year, 447 billion. That's about 45 billion growth in customer deposits. A lot of that, as you observed, has gone towards government credit or trade or the treasury, and the reason therefore, and because of that, you see therefore that there has been some softening on the private credit side. Two things to that I would like to mention. One is that we do have a very healthy pipeline of approved transactions waiting for drawdown. However, given that we're in COVID still, a lot of customers are taking time to decide to make those investments that they intend to make. And they continue delaying, looking at the supply chains, looking at the business climate. Now that the curfew has been removed fully, I expect to see that pent-up demand that has built up will start to get satisfied by customers making drawdowns on the loans that we have approved. So we do expect to see a turnaround on the private sector side.
Should investors be expecting your portfolio of government debt to continue growing at roughly the same pace? Because the year-on-year number here was about 25%, going up to 189 or so billion Kenyan shillings in government securities. Should we expect similar growth at least through to end 2022?
Well, our view is that we are very ready to shift our lending to the private sector. But obviously that speaks a lot to customer demand. Customer demand is what we're looking at. As I said, we have many approved loans that have not drawn down. We also have many that we're considering that are not at the point of conclusion. Our hope is that we'll see some good growth there. So our projection today is that we shall see a shift next year towards more private lending as opposed to government lending from the bank. So should investors expect that our government lending will grow at the same pace? I would not bet on it.